tax deeds and liens and do the same thing.
Yeah.
Trade it up.
Sure. Absolutely.
You can't do that to your personal residence. So.
No, yeah, you can't own, and that's something I'll talk about, but while we're on it, since we kind of got off topic specifically on the real estate, when you're buying real estate in an IRA, it's got to be an investment only. Can't be anything that you're planning on using personally. Like, for example, folks want to buy a house. I've got a kid that's going to go to Baylor, and I want to buy a house in Waco and allow he and his buddies to live in it while they're there and then turn it into a rent house. Can't happen. Can't buy a lake house and then use it 1 week out of the year. It's just, even if you're paying the going rate. Now, we're not hiding in the bushes watching for you, but if we see anything that concerns us that you might be doing something that would be prohibited, we're gonna tell you to stop, and if you won't, you're gonna have to find another custodian. Private equity investments, we've already covered a lot of these. LLCs, limited partnerships, private stock, C Corp. We see a lot of folks, like we had folks that bought Facebook before it was public, things along those lines. In Austin, we see a lot with angel investors, things along those lines, where you're investing into stuff before it goes public. We're doing a lot right now with crowdfunding portals, becoming very, very popular. We're the preferred custodian for one of the largest peer-to-peer lenders that's called Lending Club, if you've heard of it. And so that side of the industry is growing very rapidly, and they're kind of learning how to deal with us because all of those guys are very tech savvy and they want everything to happen online. And our industry's been very manual because of the types of investments where somebody's mailing us a PPM that's 500 pages. And so we're all kind of trying to meld together at this point in time. Private debt investments, again, notes backed by deeds of trust. Different states call them different things, mortgages, trust deeds, whatever. Basically, it's a promissory note backed by a deed of trust. We don't determine what the interest rates are or the terms, things along those lines. That's between you as the lender and the borrower. Again, same issues there as buying real estate. You can't loan money to yourself, can't loan money to a family member that's lineal. As weird as it is, you could loan money to your brother or your sister or your cousin. Can't loan money to your spouse, mother, father, son, daughter. So, and then private offerings of corporate debt for folks that are raising money that don't really want to give away equity interest. They'll do corporate debt offerings as well. So some of the pitfalls, what do you have to be concerned about? And again, we've touched on some of these, but the exact definition of a prohibited transaction is basically, it's got to do with the intent is in those transactions that run afoul of what the account is intended for. Your IRA is intended for retirement. Any action or transaction that could be construed as providing the account holder with direct use or benefit could be prohibited. So personally borrowing from your IRA, can't do it. Using the IRA as security or collateral on a loan, cannot do that. Transferring plan assets, lending money, providing goods and services to a disqualified person. The account holder is a disqualified person. Lineal family members, disqualified people. Selling or leasing property to the account holder. If you buy real estate in your IRA and then you've got it in the account and you decide, hey, I'd like to buy that property. I want to use it. So you got this lake house in there and you decide that that's where you want to retire. You can't sell it to yourself. You can't sell it to your spouse. The option you have at that point in time is you could take a distribution of it. So you can take what's called an in-kind distribution. You don't have to sell the property. You take an in-kind distribution. You're going to basically take that property out of the IRA's name, put it into your name, and you can do that with any of these different assets. And at that point in time, you're going to be taxed based on whatever the most recent appraised value is of that property. That's how you get your hands personally on an asset out of your IRA. Can't sell it to yourself. It won't allow you to do it. Not to say people don't try and get tricky with it and sell it to their friend who's supposed to sell it back to them. Anything that we see, obviously we're not going to allow that to happen. But ultimately, to check all the boxes, to do it the right way would be to take a distribution of that property or stock or whatever it may be. Now, if it's in a Roth, you can take distribution of it and not pay any taxes on it, assuming that you've met the requirements. Some of the risks and drawbacks of self-directed IRAs and the stuff that you want to keep in mind before doing any type of private investment, regardless of what it may be. These types of assets a lot of times are illiquid, for real estate. For example, you buy a piece of raw land in your account and something comes up and, like I said, you're about to be foreclosed on and you're going to be living on the streets, and so you need to get your hands on that money. There's nothing that we can do as the custodian to get that money available for you. It depends on the market. You've got to sell that property. Likewise, if you're invested into a private offering like A-List, it's up to them to determine what the liquidity dates and whether it's not like a stock or mutual fund where you can go sell it today and in 2 days, 3 days have the cash. I mean, it's really going to depend. Sometimes it's based on quarterly basis. Sometimes it's annual. And so coming to us and getting mad at us, that's usually what happens. There's not a lot we can do about it typically. It's between you and the investment. Same thing with the promissory note. Any of those types of assets can be considered illiquid. So if you run into a situation that you really got to get your hands on those funds, you're at the mercy of what it takes to liquidate that asset, whether you can find a third party to buy it from you or if you can liquidate it some other way. These are self-directed accounts. You know, we as the custodian are going to make sure that you don't do anything that's going to run you afoul of the IRS that's very obvious. But at the same time, we're not watching your investment to make sure that it's performing the way that it's supposed to. We're going to provide you with online access. We're going to send you quarterly statements. We've got a toll-free number that we're going to answer when you call and can give you any specifics on your account. But we're not a note servicer. We're not a property manager. We are not going to watch and make sure that your 8% dividend that's supposed to be paid from the stock or whatever it may be is coming in. Now, if it does, we're going to post it to the account where you can see it. We'll put any correspondence to where you can see it. We'll provide you copies of everything. But at the end of the day, it's not our role to make sure that your assets are performing. You've got to be hands-on and make sure you're involved with what's going on in your account. The administrative fees are going to be a little bit higher. You know, you can open an IRA with TD Ameritrade or Bank of America or any of those guys and probably not pay a fee. If you do, it'll be very minimal. It'll be based on the trades. We're not making anything off of any of the investments. We don't get paid kickbacks. You buy a piece of real estate, we're not getting any commissions. We don't make anything other than our fees. And so in order to maintain the staff that we need to do to process the investments, to continue enhancing our technology, we have to charge fees. And so as opposed to paying $20 a year or whatever it may be to a firm that's making money off of your investments because you're invested in their mutual fund or whatever it may be, you're going to pay us a couple $100s a year typically for our services. So the fees are going to be a little bit higher. And then in certain situations, unrelated business taxable income or UDFI, unrelated debt financed income from having debt financed real estate, which is an entire presentation in of itself, and it's not one that anybody wants to hear, I promise, but we can talk about it. Yeah, I can send you some information on UBTI. Basically, you can have taxes generated on an asset in your IRA. Typically, with a self-directed IRA, it involves around a couple of things, but it's usually if you've got an investment that's usually in real estate and there's debt financing involved, and you generate $1,000 or more of that UBTI, then there can be tax due. We're going to send you to your tax advisor if there's any concerns. Usually you're going to get a K-1 or something from the investment that would show you that there's potentially UBTI, and we're going to send you straight to your CPA, and then they'll help you calculate it to determine if it's due. Come back to us. We'll file the 990T and send the money. It's got to be paid. That tax has to be paid from your IRA. It's usually taxed on the trust rate, so it's high. But we'll take care of it, but we're not going to calculate it for you, basically. But if you do have any specific questions about UBTI, I'd be happy to refer you to somebody else. No, I'm just kidding. Services provided by a custodian. So what do we do? I've already talked about what we don't do. We've already talked about some of the stuff that we do, but I mean, what else do we do? We process your investment instructions. We do what you tell us to do, assuming that it's allowable. We're going to provide you with online access that updates in real time so you can see anything that's happening in your account. We provide you with quarterly statements. They're going to reflect all of the different assets, any cash movement, any necessary information that's going on as far as contribution deadlines, things along those lines. We're going to process your distributions if you decide to take money out of your account. We will provide you with required minimum distribution notices when you get to age 70 and a half so that you don't have to pay any penalties for that. We will also provide courtesy calculations for RMDs. We don't automatically do it because there's too much assumption there because we don't know if you've got IRAs somewhere else. But if you want us to calculate your RMD based on what you have with us, we're always happy to do it for no cost.
Who would calculate it otherwise?
Typically the CPA or the yeah. I mean, there's charts and things out there online you can use for it. And if somebody will come to us and say, you know, I've got an IRA at Fidelity that has $100,000 and I've got the one with you, can you calculate it based on that? We can do it. But it's just, we don't automatically, we used to automatically do it, and then we just had problems with people saying, well, you provided me this courtesy calculation. I took an RMD based on that amount, and then I found out that I needed to take some from another IRA. Why didn't you tell me? It's like, well, we can only tell you what we know. So do all the process, all the tax reporting, 1099-Rs if you take any money out of the account. We'll issue a 5498 every year, which basically reflects the value of the IRA and any type of activity as far as contributions, rollovers, etc. One thing that I will tell you that shows that the IRS is very interested in self-directed IRAs, there are new fields on 1099-Rs and 5498s that are asking specifically about asset types. I don't know if you've seen any of that. This year you're going to start seeing it. So it used to just say what the value was of your account. Now it's going to be if it's real estate or if it's an LLC, things along those lines. So there's going to be a little bit more scrutiny, and that makes it that much more important for us to get updated valuations and make sure what we're reporting is accurate, so that if you are audited, that it's accordingly and reported the way that it should be. What we don't do, again, investment advice. We don't tell you what to do. We're not going to provide any advice. We don't sell our own investments. We don't promote anybody's investments. We do not provide any tax advice. We're obviously going to answer any general questions you have about contribution limits and can I do this, can I do that. But if you have any real specific tax situations that you need help with, we are going to refer you to a tax professional of your choosing. We don't keep anybody on staff nor have anybody that we have to send it to. I've got one in Austin now that I can send you to for sure. And legal advice. We don't have any attorneys on staff that work with our clients. If you run into a situation where we tell you that you might need a legal opinion to do the investment, or if you need an attorney to draw up an LLC or whatever it may be, we can't do it. We know of a few, but typically we're going to tell you to go out and find your own attorney. And with that, I'll leave it. There's our contact information. This address actually just changed this week, so the Technology Boulevard is no good, but it is at 600 Congress Avenue now in Austin. The Waco address is the same. If you have any other questions, I'll be happy to answer it.